Trying to figure out the world of mortgages can feel like solving a giant, complicated puzzle, right? Especially with home prices where they are today. Affordability is a huge, huge challenge. So, in this explainer, we're going to demystify two really key pieces of that puzzle to help you see the whole picture a little more clearly. So, here's the big question, isn't it? The one every single person hoping to buy a home is asking. Is there some kind of secret shortcut, a hack to get into that dream home without waiting for years and years? Well, today we're going to look at one strategy that looks like a shortcut, and then we're going to look at what the lenders are actually seeing on their end. Let's dive in. All right, first up, the interest-only mortgage. Now, on the surface, this thing can look like an amazing deal. I mean, a way to get into a home with a monthly payment that's way lower than you thought possible sounds pretty great. But you know how it goes. If it seems too good to be true, there's probably a catch. So, what exactly is this thing? Well, an interest-only mortgage is pretty much what the name says. For a fixed amount of time, usually something like 5, maybe 10 years, your monthly payment only covers the interest on the loan. That huge number, the principal, you're not paying a single dime towards it. Not yet, anyway. And of course, that makes those initial payments a whole lot smaller. Okay, so when you lay it out like this, the contrast is, wow, it's stark. On the pro side, yeah, you get those lower payments right out of the gate, which frees up cash flow. Super tempting. But look at the con side. This is serious stuff. The biggest one, you're building literally zero equity with your payments. Nothing. And then there's this ticking clock called payment shock, which we'll get to, and a much higher risk of losing the home. All right, let's dig right into that catch. Because with these loans, that temporary relief you get in the beginning, it can come at a really, really high price down the road. And here's the kicker, the detail that changes everything. Most of these interest-only loans are not your standard 30-year fixed mortgage. They're usually adjustable rate mortgages, or ARMs. That means you get that nice low fixed rate for the first few years. But after that, the rate starts to float with the market. So you're facing a double whammy. You suddenly have to start paying the principal, and your interest rate could be going up at the exact same time. This timeline just lays it all out perfectly. Let's imagine a common 7-1 ARM. For 7 years, life is good. Your payments are low, they're predictable, you're just covering the interest. But then year 8 hits, and bam, that's the payment shock we've been talking about. Your payment doesn't just go up, it skyrockets, because now you're paying principal plus a new potentially higher interest rate. And those much higher payments, they're what you're stuck with for the next 23 years. So what do you do when that day of reckoning comes? Well, you've got a few choices. You could try to refinance into a totally new loan, but that's not a guarantee. It all depends on your credit and the home's value at that moment. You could just sell the house and hope you've made enough to pay off the loan. Maybe you've been saving like crazy and can make a big lump sum payment. Or you just have to bite the bullet and start making those huge new payments. Okay, let's switch gears for a second. We've talked about the big risk of not building equity. Now let's put on our banker hats and look at why equity is so critical from their point of view. For a lender, it all comes down to risk, and the main way they measure that risk is with something called the LTV ratio. Loan to value, or LTV, this is basically the lender's favorite measuring stick. It's how they size up the risk of loaning you a huge chunk of money. It's a super simple percentage that just compares your loan amount to what the house is actually worth. A high LTV means you're a high risk, and a low LTV means you're a much safer bet. And honestly, the math couldn't be simpler. You just take the amount you're borrowing and divide it by the home's official appraised value. So say you get a $90,000 loan on a home that's appraised for $100,000, your LTV is 90%. That's it. That one little number tells the lender exactly how much of your own skin you have in the game. Okay, so the math is easy, right? But what that number means, oh, that's huge. Because in the entire mortgage game, there is one number that is like the key to the kingdom. It's the magic number that basically determines everything, your interest rate, your extra costs, the whole shebang. And that magic number is 80%. That's it, 80. You want to tattoo this on your brain. It is the gold standard for lenders. An LTV of 80% or less tells them you have at least 20% equity in your home. And to them, that means you're a safe bet, and they'll reward you with their very best interest rates and loan terms. So what happens if your LTV is over 80%? Well, then you have to buy something called private mortgage insurance, or PMI. Now get this, and this is super important. PMI does not protect you at all. It protects the lender in case you can't pay. It's basically an extra fee you have to pay every single month, adding hundreds or even thousands of dollars to your costs each year, all because your LTV is too high. And as you can see here, not all loans play by the same rules. For a standard conventional loan, hitting that 80% LTV is how you avoid PMI. But with an FHA loan, you can get in with a tiny down payment, but you're stuck paying mortgage insurance for the entire life of the loan. Then you have VA and USDA loans, which are amazing because they can go up to 100% LTV with no PMI, but they have their own fees. It's always a trade-off. All right, let's bring this all home. We've talked about a tempting shortcut with some serious pitfalls, and we've peeked behind the curtain to see how lenders think. So, what's the takeaway for you? How do you put these two ideas together to make a smart choice? This quote really just hits the nail on the head. The low initial payments are, of course, really appealing. But the big danger, the fundamental flaw, is that you are building zero equity. You are essentially just renting your own home from the bank for those first several years. And that right there, that's the whole ballgame. Your down payment is the most powerful weapon you have in this process. A bigger down payment immediately lowers your LTV ratio. A lower LTV gets you a better interest rate and lets you skip paying for PMI altogether. See how it all connects? You're in the driver's seat. So in the end, it really all comes down to one question you have to ask yourself. Is that immediate short-term cash flow flexibility worth the huge long-term risk of payment shock and building zero equity? Or is taking the more disciplined path, saving for a bigger down payment to get a lower LTV, the smarter, safer way to go? The answer is different for everyone, and it all depends on your money, your discipline, and how much risk you're willing to take on.